Welcome, everyone. We're doing a deep dive today into some, well, pretty significant economic waters. We're looking at why the U.S. economy seems to be facing these surprisingly strong headwinds, despite some recent resilience. And it really seems to boil down to one major policy shift: tariffs. We've got excerpts here from a new report, Tariff Turbulence, America's Economic Headwinds 2025. And, well, our mission today is simple. We want to cut through the noise, give you a shortcut to understanding what these big tariff changes mean, for the economy, for your wallet, and the wider global picture, too. We'll pull out the key nuggets, the surprising facts, really help you get up to speed quickly.
Indeed. And this report, it gives a very data-driven look at the sort of cascading effects of this whole tariff situation. We'll break down those key numbers, look for the patterns, and talk about why it actually matters to you. Providing that context is key.
Okay, let's dive straight into the data then. The first thing that jumps out is just how fast and how high these tariff rates climbed. The report points to this really dramatic shift. Early 2025, rates shot up from, about 2.5%?
That's right, around that historical norm.
To a peak of nearly 27%. And that's a level we haven't seen in America since the 1940s.
Exactly. That comparison really says something.
So what was happening back then in the 40s? How does the report frame that comparison?
Well, the 1940s context was very different, of course, largely driven by wartime revenue needs, a totally different global trade setup. What's fascinating now, though, isn't just the rate itself, but where that money goes.
Straight into federal revenue, right?
Right into federal coffers. The report notes tariffs now make up about 5% of federal revenue. Historically, it's been closer to 2%.
Wow, 5%.
Yeah, that's quite an increase. It signals a considerable and growing reliance on this specific tax, a big shift in fiscal policy, really.
Okay, this next bit is where it gets, frankly, a bit concerning. We're talking GDP forecasts. Both the Fed and the OECD, they've lowered their 2025 growth forecasts for the U.S. significantly, down to between 1.6% and 1.7%.
Down from 2.8% in 2024. That's a big cut.
It is. But the Yale Budget Lab numbers are even more striking. They estimate that all the tariffs put in place in 2025, well, they're projected to cut real U.S. GDP growth by 1.1 percentage points.
A negative 1.1 point hit.
Yes, specifically looking Q4 to Q4, so that gives a clearer annual picture.
Yeah.
That just seems huge. What's the mechanism there? How did tariffs cause such a big predicted drop?
Well, the report suggests it's hitting on multiple fronts. You connect the dots, and it's about less consumer spending because things cost more. It's also reduced business investment, because of all the uncertainty, and just a general dampening effect on trade overall. And looking longer term, the estimate is for a GDP that stays about 0.6% smaller. That translates to roughly $170 billion a year in 2024 dollars.
So it's not just a temporary thing.
No, not a blip. It's seen as a considerable long-term drag on the economy. Basically, the economic pie gets permanently smaller.
So let's bring that down to earth. What does this mean for you, listening right now, for your daily life? These tariffs, they're not always obvious, but they act like a kind of hidden sales tax on imported stuff, right? Whether it's parts for your car or clothes.
Exactly. The cost trickles down.
And the report quantifies this. It notes roughly a 1.3% increase in consumer prices just from that initial April 2nd policy.
Right, and then it climbs.
Climbs to about 2.3% when you factor in all the 2025 tariffs. And that translates, according to this report, to about $3,800 less purchasing power per household. That's in 2024 dollars.
That's a significant bite out of the family budget.
It really is. That's, maybe skipping a vacation or putting off repairs. Now, other estimates do vary. The Tax Foundation puts it lower, around $1,300 per household for 2025.
Okay.
But then you see figures cited from Senator Schumer's office or PolitiFact suggesting annual costs anywhere from $3,100 up to maybe $4,900 per household. So quite a range, but all pointing upwards.
And this feeds directly into the bigger inflation picture, doesn't it?
How's...
Well, overall, consumer prices rose about 2.6% year over year in June 2025. And if you look at what economists call core PCE inflation, that strips out the volatile food and energy that was even higher, around 2.8%.
Still well above the Fed's target.
Still above that 2% target, yes, which indicates this persistent inflationary pressure that just, eats away at your living standards.
So you've got slowing growth, your wallet feels thinner, and the report says when they collide, economists start using the S word.
Stagflation.
Yeah, stagflation. That really challenging scenario where the economy basically stalls, but prices just keep going up. A tough spot.
It's a very difficult paradox for policymakers. It really limits the Federal Reserve's options, you see.
How so? What's the bind?
Well, they face this really tough balancing act. If they fight inflation too hard, say by raising rates, they could slow growth even more, maybe tip into recession.
And I.
But if they try to stimulate growth, maybe by cutting rates, they risk making inflation even worse.
It's damned if you do, damned if you don't. Kinda.
In a way, yes. It really squeezes living standards higher costs without a booming job market, and it seriously restricts the Fed's room to maneuver.
Okay, let's talk about that labor market then. How is this playing out in jobs?
Yeah.
July 2025, the numbers weren't great. The U.S. added only, 73,000 jobs?
Yeah, fell well short of the forecast, which was closer to 115,000.
And layoffs were up too.
Sharply, around 62,000 job cuts announced.
So what kinds of jobs are we seeing affected? Does the report link this directly back to the tariffs?
It does. Citing Moody's analytics, it specifically points to slowdowns in manufacturing and construction jobs as being, well, directly tied to these tariffs.
Makes sense.
Think about it. Higher tariffs on imported steel or, electronic components, that raises costs for manufacturers. They might have to scale back hiring or even lay people off.
And construction too.
Same idea. Tariffs on things like lumber or other building materials make projects more expensive. That can lead to delays, maybe even cancellations, fewer jobs. Plus, the report also mentions that labor force participation has kind of stagnated, and it partly links that to restrictive immigration policies, adding another layer of difficulty for the labor market.
And this weakness, it's not just about the number of jobs, is it? It's hitting actual industrial output too.
Absolutely. Manufacturing activity is definitely feeling the pinch.
How are we seeing that?
Well, factory orders dropped pretty sharply, 4.8% in June 2025. Now, that followed a big surge in May, but still.
A reversal.
Yeah. And overall, manufacturing activity fell to a 9-month low in July. The report specifically notes that the sectors most exposed to tariffs were hit hardest.
So a clear signal there.
A clear signal that these higher import costs are working their way through supply chains and affecting overall production.
And the financial markets. They haven't exactly shrugged this off either.
No, not at all. The report points back to that April 2nd tariff announcement. Some sources in the report actually called it Liberation Day, interestingly enough.
Liberation Day. Okay. And what happened?
Well, it apparently triggered a global market crash. The S&P 500 fell about 1.8% right away. The NASDAQ 100 down about 2.6%. And subsequent losses apparently wiped out all the gains markets had made since November 2024. So a major hit to investor confidence.
It really does sound like a perfect storm brewing. Are there other nuances here the report brings up that make this situation particularly tricky for policymakers, beyond just the obvious challenges?
Well, yes, this risk-off sentiment we saw in the markets, it isn't just about the numbers. The report frames it as a kind of crisis of confidence.
Confidence in what?
Confidence in stability, in predictability. Imagine you're trying to run a business, make big investments. How can you plan when the trade rules keep shifting dramatically?
Right, the uncertainty factor.
Exactly. And the report goes further. It mentions concerns about institutional credibility. They even cite the controversial firing of the Bureau of Labor Statistics Commissioner
Yes.
as something that fueled mistrust in official data. When investors don't trust the numbers or the stability of policy, they tend to pull back from risk. They go risk off.
And that pullback itself hurts the economy.
Precisely. Confidence is just. It's fundamental for a stable, growing economy.
Now, this isn't just a U.S. story, is it? The report brings in historical context, global context, too.
Yes, it reminds us history has some pretty clear lessons here. It cites these long-term studies looking at like 151 countries over decades from 1963 to 2014.
And what did they find?
They found that tariff hikes consistently correlate with statistically significant, persistent declines in economic growth. It's not just a short-term dip.
So the report seems pretty clear on the negative impacts. Does it, or the sources it uses, acknowledge any potential upsides, even minor ones? Or is it just a uniformly negative picture painted by this data?
Well, the report itself definitely focuses heavily on the downsides, and the data presented really points that way. Now, you could argue, and some analysts certainly do, though they aren't really highlighted here, that tariffs might protect certain, specific domestic industries, maybe nascent ones.
The protectionist argument.
Right. But the broad, comprehensive data in this report doesn't seem to show a net positive economic result overall. And the Yale and Fed analyses cited, they back this up globally. They find these broad tariff scenarios tend to reduce global GDP by about 0.8%.
And the U.S. and China take the biggest hits.
That's what they estimate, yes. The U.S. and China bear the largest losses, and it hits U.S. exports too, weakening them significantly, maybe by 16 to 18%. That's substantial.
So looking at that global picture, what really stands out to you?
Just the interconnectedness, I suppose. You pull a lever like tariffs here, and the effects ripple out globally, and then they circle back and impact the U.S. economy again in various ways. Retaliation, weaker demand for exports.
Yeah, it really highlights that. So, okay, let's try and bring this all together. The report seems to be painting a pretty clear picture of why the economy is in some trouble. It's pointing to consumers squeezed by higher costs,
Right.
inflation eating away at wage gains. Businesses are hesitant to invest because of all the uncertainty.
Delaying capital spending, yes.
Then there's the global backlash, retaliatory tariffs hurting exports.
Weakening trade.
Job creation is weak, especially in those tariff-hit sectors.
Manufacturing, construction.
And on top of it all, this damage to investor confidence, maybe even institutional stability concerns.
Yeah, that loss of trust.
And all of that together, the report argues, contributes to this serious threat of stagflation.
Right. That's the convergence point, yes.
Okay. Well, this deep dive into tariff turbulence has definitely laid out a complex situation. The tariff escalation in 2025, as we've walked through the data here, seems to have significantly slowed growth, pushed inflation higher, really put pressure on household budgets,
Squeezed consumers.
destabilized markets, and discouraged that crucial long-term investment. It really sounds like it's creating conditions ripe for stagflation and potentially sustained economic weakness.
Indeed. The detailed data from these various sources, it certainly paints a picture of a complex and quite challenging economic environment ahead.
Which leads us to maybe a final provocative thought for you, our listener, to consider. Given all these detailed economic headwinds we've discussed, the slowing growth, the sticky inflation, the trade friction, the uncertainty, what does this current situation really imply for future policy decisions? Not just here at home, but also thinking about global trade dynamics, about international cooperation going forward. It certainly gives us all a lot to mull over.